Hi there, welcome once again to the Dukascopy TV studio. I'm Ben Jones. Alongside me to discuss investment in private equity is Richard Ormond from FGP Capital. Richard, thank you very much for joining us today.
Good morning.
Can you begin by summarising for us very generally, who is FGP Capital?
Okay, yes, FGP Capital is an independent wealth management company founded in Geneva in 2008. And we've been focusing on fundamental research with a value bias. And this has also led us to develop a network of reputed scientists, industrial experts, financial partners. And little by little, because of our equity expertise and small cap bias, we've been getting involved in private equity transactions. And in 2013, we launched our private equity fund. So that's, in a nutshell, what differentiates us from the existing sort of portfolio management companies here in Geneva.
Okay, now what are some of the main reasons for investing in private equity?
I think there are several reasons. We see the diversification, of course, out of the classic markets, typically cash, bonds, equity, especially now that interest rates are where they are and the fact that equities are hitting new highs. The decorrelation from economic cycles is also very important, which gives an advantage to private equity. And the fact that we have, over the long term, produced much better returns through private equity investments. And there's, of course, the social and economic impact of investing in smaller companies through job creation and innovation, of course. So it makes a lot of sense to be invested in private equity, especially that when we look at some of the big family offices, they often have more than 20% exposure in this asset class.
Now, can you elaborate a bit more on your approach and your expertise?
So what we've done is basically, we've been doing a lot of due diligence beforehand, looking at different transactions, and this allowed us then to launch our fund from day one, knowing which were the companies we wanted to be invested in. And we also had a very good visibility on the exit strategy, either because some of these companies had planned different IPOs, or else because there's potentially a trade sale which could take place within the next 3 to 4 years. And therefore our fund had the peculiarities of being with a much closer, much smaller maturity of 5 years instead of 10 years compared to the usual length, and with a good visibility on the exit strategy. And what we try to do as well is to scale down the entry tickets. In private equity, you're often talking about very high entry tickets. Here, because we created the fund in-house, it was mainly to serve our own clients, to allow them to get exposure to private equity. And some of the features that we've been focusing on is, of course, typically limiting the downside risk. So one of the first investments that we did was actually a PIPE. We got involved in a convertible bond, and this was in an oncology company which had been given an FDA approval for their drug, which was enabling, on the veterinary side, dogs to be cured, dogs that had cancer. And this was the collateral that we would be using if anything went wrong on the equity side, and if anything went wrong, especially on the human trials. And today the company is listed on the French market. It's a company which has 12 drugs in phase 3, valued at 300 million euros. A similar company in the US would probably be valued today at over $1 billion. The reason for that is that we see that there's a much less, there isn't that same mindset as you have in the US of risk-taking, of capital risk. And therefore, today we can buy private equity companies at a bargain, at a fraction of the price of what you would find in the US, especially here in Europe. That's one thing. Then what we've also liked when we select private equity companies is to be able to make sure that these companies have a good product on one hand, but also that they don't need huge amounts of capital in the future. And that was the case of one of the companies we got involved in last year, Oxford Nanopore. It's a spin-off of the Oxford University. And they have developed what we believe will be a new technology in terms of analyzing molecules, proteins, DNA sequencing through a technology platform which is not optical as most of the companies are, but really it's a company which is using an electronic analysis.
And finally, can you give us a few examples of potential deals and upside?
Okay, so I mentioned a couple of companies which have closed their deals, but we are actually working on 2 transactions. We still have two open transactions that we are investing in today. One is a technology company based in Switzerland. They have developed a back office system which allows them to automate 80% of all recurring tasks. So initially they were focusing on portfolio managers who were interested in consolidating the portfolios, which is something which today seems easy, but in practice is very difficult. No one can do it on a press of a button. I mean, whereas they are using a new technology. They've improved a lot of the existing technologies, which are optical character recognitions. They have modified the algorithm, and they can now very easily upload any electronic information, but also paper information, and extract the information. So typically, initially, they were targeting portfolio managers, but now they realize that their product is also suitable for fiduciaries, accountants, trustee companies, any company which has recurring tasks which necessitate manual input. And the hit ratio that they have when they go and see potential clients is huge, because people are just amazed at what they can do with such a product, because it will reduce administrative costs by a huge margin. So that's a small company which is looking to raise 1 to 3 million Swiss francs today, but with tremendous upside. Another company that we are close to today is a company which is a French company. They're looking to raise 50 million. But what's interesting, it's a platform where they are developing a vaccine for HIV. So the HIV today, if you take classic patients, they would need to go through a polytherapy, which can cost between $20,000 in the US up to more than 30,000 euros in Europe. Whereas here we have a company which is using a new technology called lentiviral vectorology, and by doing so they are able to reduce and keep the viral load at a stable load. Therefore, and what's another interesting point is they are the only company that have been given approval to perform human trials. And the company is raising additional funding today to pursue the development of their phase 2 now on this HIV vaccine. And in parallel, they are also looking to develop a leukemia vaccine. And the idea is to come to the market within the next 2 years, list on the US market with maybe 1 or 2 other sort of vaccines, either for tuberculosis or malaria. These are companies where the upside potential is probably between 3 to 10 times, I mean, maybe even 15 times. If you compare this company today is worth just a bit more than $100 million, but euros, sorry. But if you take the HIV population, there's more than 30 million people HIV positive, and let's just exclude. And let's just be conservative and take maybe 10 million of that population which could afford to pay for the polytherapies. The upside potential is just huge.
Okay, Richard, thank you very much for joining us again.
Well, you're welcome.
And thank you for watching. Do make sure you keep clicking back to Dukascopy TV, as we'll be bringing you plenty more updates and exclusive interviews. Bye for now.